We are currently in a recession unlike any that any of us has ever seen before. On one hand, there's no shortage of money. Interest rates are at record lows, responsible lending has been eased up, and we've had record levels of government stimulus. The big challenge at the moment is productivity, and people can't work the same way that they did prior to the COVID-19 pandemic. This has quite specific implications for commercial property. The first trend is that not all cities are being impacted in the same way. On one hand, Melbourne has come out of a prolonged lockdown, and its economy will take longer to recover. On the other hand, in Western Australia, we are seeing very strong economic conditions on the resurgence of the mining boom. Canberra is also doing really well, primarily because of its reliance on the government sector. The second major trend is that there have been significant shifts in the way that we all work. Many of us have been working from home for a prolonged period, and when we do start to get back to work, many of us won't be in the office 5 days a week as we were before. This means lower demand for office space, and already we are seeing rising vacancies across Australian office markets. There is one exception, and that's Canberra, where the vacancy rate has actually reduced compared to the same time last year. The third main trend is that revenge spending is real. However, we will continue to see lots of challenges for shopping centre and retail store owners. Retail spending levels are slowly getting back to where they were prior to COVID. And in Victoria, we should start to see a pickup over the coming months. The big challenge is that a lot of spending is now moving online. Although this was happening prior to COVID-19 pandemic has accelerated it. The other challenge is that there do remain tensions between tenants and landlords, and this will impact rental levels going forward. The next trend is that industrial and commercial farming are doing particularly well. Industrial was a firm favourite prior to COVID-19. However, growth in online spending has been favourable for this sector. Commercial farming has also done well. This is partly because of the breaking of the drought. However, we are continuing to see very strong demand from investors both locally and overseas. The fifth trend is that there will be better conditions for hotels and tourism going forward. A big problem for tourism operators and hotel accommodation has been a lack of international tourists. Domestic tourism has also slowed due to border closures. We do expect a pickup in domestic tourism in particular. The main reason being is that Australians spend more overseas travelling than overseas tourists spend in Australia. If this can be captured, it will mean far better times ahead for both tourism and for hotels. The sixth trend is that it will be our CBDs that are most impacted from a property perspective. A big challenge for our CBDs is that we are seeing rising vacancy rates across all sector types. This includes residential apartments, office space, and also retail space. The challenge is that we are continuing to see a slow return of office workers, and these office workers do generate a significant amount of activity within our CBDs. A lack of foreign students is also problematic for some CBD markets, and Melbourne in particular has been most heavily affected by this. The seventh trend is that we are continuing to see very low listing volumes. The main reason being is that on one hand, we're not seeing a rise in distressed sales, which is good news. More negatively, vendors are holding back because they are a little hesitant in such uncertain conditions. And finally, the eighth trend. The good news is that commercial property values are unlikely to be impacted all that much as a result of the pandemic, primarily because there still is a lot of money around. More negatively, owners will have to get used to lower rental returns in the short to medium term.